Welcome back to the Deep Dive. So today, we are tearing through just a stack of sources that tell this incredible story of global financial connectivity.
It's a wild one.
Yeah, you shared the research, and every single article points to the same sort of paradoxical truth. It's about how this tiny, almost academic shift in monetary policy in Tokyo,
Just a tiny shift.
it had the power to send these massive shockwaves right across the Atlantic, rocking Wall Street, and making it way more expensive for the U.S. government to borrow money.
It really does sound like some kind of geopolitical thriller, but it's pure market dynamics. I mean, for decades, Japan has been the grand outlier.
Right.
While the US, the UK, Europe, they were all furiously hiking rates to tame inflation. Japan just, kept its policy pinned near zero.
And that ultra-easy stance was a foundational assumption for all of global finance.
A total assumption. And the sudden signal, the mere hint that Japan might finally be preparing to rejoin the global rate cycle, well, that's the most explosive data point we've seen all year.
So our mission today is to give you the shortcut to understanding the shockwave. We're going to trace the line from a single comment made by the Bank of Japan, see its immediate effect on Japanese bonds and the yen,
And then connect the dots.
right up to the exact mechanism, the butterfly effect, if you will, that connected Tokyo's decision directly to higher U.S. borrowing costs and, of course, stock market volatility.
And we're not just talking about minor fluctuations here. We are really discussing the mechanics of a truly global tightening of financial conditions.
All triggered by one nation.
A single nation moving away from a policy that had been stable for, 15 years?
So let's start with the flashpoint. Who lit the fuse, and what do they actually say? Because the action itself, like you said, was incredibly subtle.
It was. It was the governor of the Bank of Japan, Kazuo Ueda. And the action was an announcement that the central bank would begin to review the pros and cons of lifting rates.
Just a review.
At its upcoming meeting, he simply suggested they would look at the data and potentially hint at a rate hike in early December. Notice the phrasing.
He didn't announce a hike.
No, he announced a review out a hike.
And the market's reaction was just, it was explosive. Why? I mean, is it because the market read that not as a review, but as a commitment to finally ending the zero-rate policy?
Precisely. That's exactly it. It was the breaking of a decades-long psychological barrier. The Japanese government bond market, it just surged instantly. The 2-year yield,
Which is the most sensitive one, right, to policy changes.
the most sensitive indicator of immediate policy expectations. Yeah, it instantly broke above the 1% mark.
Okay, a 1% yield on a Japanese bond might not sound like much to someone listening in the U.S., but for context, that 2-year yield hasn't traded above 1% since 2008.
That's the crucial context. 2008, the entire structure of post-global financial crisis monetary policy in Japan has been defined by these ultra-low rates.
So breaking that 15-year ceiling.
It signals that the entire monetary architecture is now under threat, and the 10-year yield followed suit, climbed close to 1.9%. These moves, they fundamentally changed the risk-free rate inside Japan.
And what about the currency? The yen had been relentlessly weak for months.
No, the yen was having a terrible year, just getting weaker and weaker against the dollar as the U.S. kept rates high.
So what happened?
On this news, it reacted just as forcefully as the bond market. The yen literally surged nearly 1% against the dollar, just like that, in short order.
Wow.
And this tells you two things. First, that policy divergence was the main reason for the yen's weakness before. And second, that investors believe this potential shift is, permanent.
Okay, so that's the local market. Now we need to solve the central mystery of our deep dive, the global contagion. How did the suggestion of a review in Tokyo cause U.S. Treasury yields to jump?
This is the critical connection.
It's what makes it more expensive for the U.S. government to run its operations. I mean, this is where we shift from local news to something like global catastrophe planning.
And it revolves entirely around what's called repatriation risk. Higher yields spread almost instantly. We saw U.S. Treasury yields jump by the most in a month.
And the 10-year went back above 4%.
Right, back above 4%. A level the market had fought really hard to stay below.
Okay, so why does the U.S. bond market, I mean, it's the deepest, most liquid market in the world, why does it care what a Japanese central banker is thinking?
Because the Japanese investor community,
Yeah.
we're talking banks, pension funds, insurance companies, they aren't just buyers of foreign debt.
They're more than that.
They are the structural cornerstone of the Western government debt market. For years, they have been among the largest global buyers of U.S. Treasuries and European sovereign debt.
And that was a necessity for them, wasn't it? They had to invest overseas because the return they got at home, the yield on a Japanese bond, was basically zero.
Absolutely. They were forced offshore to generate the returns they needed to meet their domestic obligations, like paying out pensions.
So you could argue they were effectively subsidizing Western borrowing costs for more than a decade.
That's a great way to put it. Imagine Japan was the global credit card issuer for Western deficits, and they were charging almost nothing for the money.
That's a perfect analogy. So the question is, if the cost of money in Japan, even if it's just 1 or 2%, starts to look competitive for the first time in 15 years, what's the financial calculus for these massive Japanese funds?
The calculus changes instantly. If domestic rates offer even slightly more compelling risk-adjusted returns, those investors have a massive incentive to pull back.
So they start selling their foreign bonds.
They'll either start selling their overseas holdings, that's repatriating funds, or, more likely and just as damaging, they'll simply stop buying new overseas debt.
And that's the real danger. The catastrophe isn't just about a little less demand, it's that a structural pillar of global debt financing could vanish, just as U.S. debt issuance is soaring.
That is the core takeaway from all the sources. This loss of demand comes at the worst possible time. Western governments, especially the U.S., are running enormous deficits.
And issuing huge amounts of new debt to finance it all.
Exactly. So if a major reliable source of demand like Japan reduces its buying while the supply of U.S. debt is soaring, the result is unavoidable.
The price of that debt falls.
And the borrowing cost soars. The global cost of money tightened because the world's largest subsidized creditor finally suggested he might start charging market rate.
But wait, let me just push back on that for a second. We're talking about Governor Ueda suggesting a review. Are investors really ready to gamble that 30 years of zero-rate policy ends on a single sentence? Or is this maybe the market just overreacting?
I think the market is absolutely betting that the risk has permanently shifted. The market reaction itself is the evidence.
Okay.
Investors know the BOJ can't easily put the genie back in the bottle once it acknowledges that, hey, inflation is returning and domestic yields should be higher. Even if the actual hike is delayed, the consensus now is that the trend toward normalization has started.
And in finance, trend is everything.
It is.
Okay, let's track the ripple effect beyond government debt. Beyond just raising the immediate borrowing costs for the U.S. Treasury, what did this Japanese signal do to the broader outlook for U.S. monetary policy?
It instantly dented expectations for aggressive rate cuts in the U.S. for 2026.
So the BOJ news actually overpowered U.S. domestic data.
It did. Just a few weeks ago, the sources were noting that U.S. futures markets were wildly optimistic. They were pricing in 6, 7, maybe even 8 Fed rate cuts next year.
That's a huge amount of optimism.
It was an aggressive, optimistic bet, all based on cooling U.S. inflation expectations. But the minute the Japanese policy shift signaled that global rates might be moving structurally higher, that optimism just evaporated.
Why, though? How does that work?
Well, higher global rates mean that if the Fed cuts too aggressively, the dollar weakens too much. That could destabilize capital flows. The entire trajectory shifted.
So where are we now?
Now, futures markets only price in a few cuts next year.
Yeah.
The BOJ's potential move acted like a ceiling, limiting the Fed's room to move down too aggressively.
And where global rates go, volatility follows. The impact wasn't just limited to bonds and currency futures. We saw that volatility spill right over into risk assets on Wall Street.
Of course. When the price of money, the borrowing cost rises suddenly, high-growth, long-duration assets become way less appealing.
These are companies whose valuations are all about future earnings.
Exactly, and those future earnings are discounted more heavily when interest rates rise.
Which means tech stocks felt the pain first.
Absolutely. Tech shares led a significant pullback on Wall Street. Both the Nasdaq and the S&P 500 slipped into the red as investors sold off those riskier, growth-dependent positions.
The fear gauge woke up.
The VIX woke up immediately. Investors were rushing to de-risk.
And your sources highlighted a fascinating, really modern correlation here. The tight link between those high-growth stocks and cryptocurrencies.
That link is stronger than ever. The logic is similar, right? Crypto is maybe the ultimate high-volatility, risk-on asset. So when the risk-off button gets pressed globally, which is what the BOJ signal did, highly volatile assets suffer. Bitcoin, for example, was down 7% on the day the news broke.
Wow, 7%.
Erasing a significant chunk of its recent gains. It's a remarkable illustration of how the world of decentralized finance is now structurally tied to the monetary policy decisions of the world's major central banks.
Okay, now let's zoom out a bit and consider this BOJ movement. within the context of U.S. monetary uncertainty, because these central banks are acting in opposition to each other.
Total opposition.
What other concurrent factors are putting pressure on the dollar right now?
We have a major policy divergence unfolding. On one hand, you have the BOJ thinking about normalization. On the other hand, the domestic U.S. expectation is the opposite.
Right.
Markets are pricing in an 88% chance that the Federal Reserve will actually trim rates by a quarter point at its upcoming meeting next week.
So the U.S. is likely cutting, while Japan is talking about hiking. That removes the monetary magnetism that's made the dollar so strong.
Exactly. When that rate advantage starts to fade, when U.S. yields drop relative to global yields, money flows out of the dollar and into currencies that offer better returns.
And there's more uncertainty, too.
Oh, yeah. The sources point to policy uncertainty beyond December. There's significant chatter around the possibility of a new Fed chair succeeding Jerome Powell, and that uncertainty about future leadership always creates headwinds for a currency.
And that combination, a likely cut plus a potential leadership change, that caused the dollar to have its worst week in 4 months.
Correct. The dollar's weakening was pronounced. The euro, the British pound, they both gained ground. And this whole shift is further supported by underlying U.S. economic data.
What are you seeing there?
New data showed U.S. manufacturing contracted for a 9th straight month. That multi-quarter contraction adds pressure on the Fed to ease policy, which then just reinforces the dollar weakness we're seeing globally.
So if we look at all these converging factors, the Fed likely cutting, the BOJ likely ending its easy stance, and the U.S. economic slowdown, it really sounds like December and early 2026 are set up for some high-stakes decisions that are going to ripple far into the future.
They are high stakes globally. We're watching 3 major policy tracks converge at the same time.
Okay, what are they?
First, the Bank of Japan could end decades of ultra-easy policy, which would fundamentally change the cost of global capital. Second, the Fed will likely confirm its rate cut, forcing investors to assess how aggressive 2026 will be.
And
Third, the market will be desperately seeking clarity on the successor to the Fed chair, which dictates the long-term inflation growth policy path for the world's reserve currency.
that is a phenomenal amount of concentrated uncertainty. But if we distill the simple message from the markets, driven by that shockwave from Tokyo this week, the message is clear.
What's the takeaway?
The world had grown accustomed to Japan being a silent, passive buyer, just financing global operations without demanding a better return. That era, defined by a fixed price on money, it appears to be ending.
Yeah.
When Japan moves, global economies react very, very quickly.
It's a powerful lesson in interdependence. Every central bank decision is connected, and removing one seemingly stable anchor, Japan's zero rate, can throw the entire ship into choppy waters.
So here is the final provocative thought for you to consider, based on all the material we've reviewed today. The sources highlight that Western governments, including the U.S., are running enormous persistent deficits. They're issuing vast amounts of new debt every month. What happens to the cost of that debt, and what happens to the taxpayer who ultimately funds it if one of its most reliable long-term buyers, the Japanese investor, permanently walks away and demands that money be paid back, or simply stops buying?
That's the question.
That's the real high-stakes question hanging over the global economy heading into 2026.